Today, I want to talk about an issue with the Canada Pension Plan, our national pension program that every employed person in the country pays into. More specifically, I want to talk about the Canada Pension Plan Investment Board, also known as CPP Investments, the crown corporation that manages the investment of funds held for the CPP. In particular, I want to talk about their active investment management strategy for choosing the investments of the overall fund and how it's been performing since they decided to pursue it 18 years ago. That's right, folks, it's time for the first ever deep dive video from your old pal Millennial Moron. If you follow me on social media, you know I've been talking about this one forever, and I put a lot of work into this video over the last several months, so hopefully you'll find it worthwhile. Now, this issue has been discussed a little bit in the mainstream media in the past, but it's an issue that spans decades, and in my opinion, it's something that should be a bigger issue in public discourse. In the past, we spent weeks arguing over $16 orange juice or thousands of dollars spent on airplane food, but this active management strategy costs us billions of dollars each year, which is more than even the largest political scandals on the Canadian stage. And in this past year alone, we've missed out on tens of billions of dollars in gains for the Canada Pension Plan because of it. But first, I want to clarify a couple of things that this video is not about. First of all, this is not about the CPP running out of money. According to the 31st actuarial report, which was published in November of 2022, the fund is in good shape to be sustainable for at least the next 75 years. If you don't know what an actuarial report is, an actuary is basically like an accountant that uses statistical methods to model future scenarios. They use current information like population demographics and income statistics, as well as assumptions about the future in order to make projections of what will happen in the coming decades. In the case of a pension plan, their goal isn't to predict exactly what will happen, it's to make sure that the pension fund is robust against a variety of future possibilities, and make sure that retirement benefits are secure even if something unexpected happens. So basically, the wave of baby boomers retiring isn't going to destroy the plan financially, because that's already been accounted for. I looked through the report and I've got no reason to doubt their conclusion. The current CPP system was set up with fairly conservative assumptions in terms of contribution rates, benefit payouts, and investment returns, so over the past 25 years, the financial stability of the CPP has actually improved, not gotten worse. I also want to make it clear that this video is not anti-Canada Pension Plan. Even though personally I would prefer to keep the money and invest it for myself, I do see the value in having a program that provides a financial backstop in retirement for the whole of our society. I also think the risks of eliminating it far outweigh any personal benefit I might get from managing more of my money independently. In addition, it's a program that mostly has widespread public support. I also think there's a benefit to having a single national plan. I'm not trying to advocate for something like each province having its own plan. That would just be splitting the fund up into pieces and duplicating the bureaucracy, as well as creating a huge mess of paperwork for anyone who's lived and worked in multiple provinces throughout their life. Keeping it as a single fund is, in my opinion, the most efficient way to handle it. What I do want to talk to you about today is the Canada Pension Plan Investment Board, or CPPIB, also known as CPP Investments, and their active investment management strategy. These are the people who manage the investments of the Canada Pension Plan Fund, and over the past 18 years, they've spun up a large financial corporation to pursue an active management strategy of selecting individual investments rather than passive investments in the overall market, which is what we did before. They have over 2,000 employees in the organization with over $1 billion in annual personnel costs. They've opened multiple international offices. They pay billions of dollars a year in external management and financing costs, and it's all in the pursuit of picking investments in an attempt to outperform the overall market. Naturally, as you can see on their website, the people getting paid to implement this strategy think it's the right choice. First, one thing you need to understand if you want to understand the overall issue here is the difference between active investing and passive investing. Active investing is what most people think of when they think of professional investors, picking individual stocks, individual companies to invest in, and reacting to financial news in an attempt to time the market and get the best returns possible. Generally, this comes along with a lot of investment staff and a lot of fees. In contrast, passive investing is a low-effort, low-cost strategy where you just pick a certain asset allocation, a certain percentage in stocks, a certain percentage in bonds, and then just stick with that strategy and don't make major changes even as the market fluctuates. If you really want some exposure to things like private equity and private real estate, you'd pick a certain percentage allocation, then buy funds that invest in those things rather than directly buying the assets yourself. In other words, you're not trying to beat the market, you're just trying to match the performance of the investment market overall while minimizing your costs. Passive investing is, for example, how I manage my own personal investments, but it's also a viable way to manage much larger amounts of money for a low cost. There are pension funds out there that are mostly or entirely passively managed, and the CPP fund used to be passively managed until 2006 when they switched to active management. When they made the switch, the CPPIB even developed a passively managed reference portfolio that would meet the CPP's needs for paying benefits over the long term, which they identified as a strategic alternative that they could use to measure their actual performance against. This reference portfolio, to be clear, isn't just a random stock index benchmark. It's a portfolio that the CPP Investment Board specifically created to meet the actuarial requirements of the Canada Pension Plan and be able to pay out benefits over the long term. It's a mix of global equity and bonds chosen to balance long-term returns against the risk of loss in individual years. The CPPIB specifically stated that this was a viable low-cost alternative to active investing all the way back in 2007. They've said that the overarching goal of their organization is to provide above-market returns, and the way to measure that is by comparing their performance against this reference portfolio, which they created for themselves as a passively managed alternative that would meet the actuarial requirements of the CPP, meaning that the reference portfolio strategy would still be able to ensure the payout of benefits over the long term. They used to have specific targets for how much they wanted to outperform the reference portfolio by each year. They even said that compensation should be tied to their performance against the reference portfolio because compensation was key to attracting top investment talent, which is what they need to outperform the market, again, as measured relative to this reference portfolio. They also use the reference portfolio as the risk target for their actual strategy, so it's not as if we're talking about two completely different strategies that can't be compared in terms of pension fund management, but I'll get into that later on. I know I'm belaboring this point quite a bit, but I really want to impress upon you that the reference portfolio is not some arbitrary, unrealistic performance target. It's a metric they created for themselves, and they've said from the very beginning that it's a key accountability metric to justify their current strategy. After all, if their investment team can't outperform a passive strategy that would only require a handful of people to manage, why would we need a large, highly paid active investment team? So, in pursuit of this goal of above-market returns, they've hired thousands of investment staff, expanded their personnel costs to over $1 billion a year, spent billions of dollars on external management fees, and opened 8 international offices to pursue value-added investment opportunities. Now, while active management is still quite common, it does have a key problem that's been known for many years. That problem is that over the long term, active management tends to underperform the market because beating the market long term is essentially an impossible task when you're managing a large amount of money. This idea was brought to popular attention in an article called The Loser's Game by Charles D. Ellis, published all the way back in 1975 in the Financial Analyst Journal. Ellis writes, "The investment management business is built upon a simple and basic belief. Professional money managers can beat the market. That premise appears to be false." The basic idea of the article is that, although back in the old days, the most knowledgeable investors could outperform the overall market by quite a bit, it was because they were competing against a large number of amateur investors. However, since roughly the 1950s, most trading activity actually comes from sophisticated institutional investors who know what they're doing. They all have access to the same high-quality data and the same analysis techniques, and today, the overwhelming majority of trading activity in the market is coming from experts. That essentially means that if you decide to try to beat the market through strategic decision-making, your decision will, on average, be a mistake because you're competing against the collective knowledge of an entire gigantic industry. An individual investor might beat the market over a period of a few years, but over the long term, they will eventually accumulate enough underperforming years that their long-term relative performance is worse than the market overall. Another big factor is the fees involved. When you have more investment professionals drawing salaries and spending money to try to beat the market, that comes out of the returns. And any extra value they might gain through trading strategies is almost invariably less than what it costs to pay them to do it. This isn't just a hypothesis either. It was backed up by data in the 70s and has been proven out again and again over the last 50 years. As an example, the Globe and Mail recently published an article on the topic and pointed out that over a 5-year period, about 96 to 98% of Canadian fund managers underperform their benchmark. And keep in mind, that percentage tends to rise as the time period gets longer. There was also a famous bet involving Warren Buffett, well-known investor and inventor of the all-you-can-eat buffet. He made a $1 million wager with a hedge fund management firm that just throwing money into an S&P 500 index fund for 10 years would outperform their hand-picked portfolio of 5 hedge funds. Not only did Buffett win the bet, but the passive investing strategy did better than every single hedge fund in the portfolio individually. This also applies to pension fund management specifically. This article in the Journal of Portfolio Management discusses how actively managed public pension funds have been underperforming passive management strategies for decades. Keep in mind, what we're discussing here is an issue of opportunity cost. Actively managed investment funds generally still make profits, it's just that those profits tend to be lower than what they could have made if they ditched most of the investment team and just tried to match the broad market performance. Overall, despite everything the investment industry has been attempting to do for the past several decades, the only reliable way to improve your investment performance in the long run seems to be reducing costs, not picking investments and timing the market. Now, in general, there's 2 ways that actively managed funds end up underperforming the market over the long term. A, they underperform a little bit each year and it adds up over time, or B, they overperform the market a little bit in most years, mixed with a handful of years where they seriously underperform the market, which averages out to worse performance overall in the long term. That second scenario of mostly good performance punctuated by a few years of very bad performance is the story we're talking about with CPP Investments. In many years, they do outperform their reference portfolio by a little bit, but in the years where they underperform, it's usually by a larger margin than their accumulated overperformance. So that brings us back to the recent performance of the pension fund and how they've been doing relative to their reference portfolio. Last year, they released the financial report for fiscal year 2024, which ended on March 31st of 2024. But first, let's take a look at 2023 to see how they normally report their performance. You can see here on the summary page for 2023, which is right after the table of contents, that they had a net return of 1.3% or $8 billion. You'll notice that they also show their performance against the reference portfolio, which is an extra 1.3% or $2 billion over 1 year, and 0.8% annually, or $7 billion over 5 years. They also state that the total value added since the start of active management in 2006, after compounding the extra returns, is $47 billion more than what the reference portfolio would have returned. Down here on page 39, they mention that the cumulative uncompounded value added is only $21 billion, but since they're reinvesting that amount, I think using the compounded value is also a fair comparison. By the way, if you're watching closely, you might have noticed that the 1.3% $2 billion overperformance doesn't really make sense when the overall return was 1.3% and $8 billion. On page 40, they show that the reference portfolio return is 0.1%, but on page 73, they show a reference portfolio return of $5.9 billion, which, based on the numbers in this table, would actually be about 1%, not 0.1%. I'm not an accountant or anything, but I think someone may have made a typo there. Anyway, let's take a look at the most recent report from 2024. Here on the summary page, printed in a nice big font, they show an overall return of 8%, or $46.4 billion. That's a lot of money, and seems to be a much better year than 2023 for the fund. However, you'll notice that the performance against the reference portfolio is conspicuously missing this year. If you want the details of how they performed against the reference portfolio last year, you have to scroll all the way down to page 39, where you'll see, in regular size font, that the reference portfolio returned 19.9%, making their relative performance negative 11.9%, or negative $64.1 billion. Over the past 5 years in total, the average value added was negative 2% annually, or negative $63.7 billion, and over the past 10 years, it was negative 0.3% annually, or negative $45.7 billion, and if we go all the way back to the start of active management, 18 years ago, it's negative 0.1% annually, or a total of negative $42.7 billion, compared to what we would have made if we went with the low-cost, passively managed reference portfolio. Keep that in mind, because whenever this happens, they brush it off as one bad year, but the bad years have now added up to a below-market return when averaged over all the years since they started doing active management. It's not just a bad year, it's a year so catastrophically bad that they've wiped out much more than any value they may have created over the previous 17 years combined. Of course, these results don't look great for the active management strategy, so they left them off the cover page and put them a few dozen pages in on a page with smaller font and no graphics. Similarly, in 2021, we see that the fund returned 20.4% for a profit of $83.9 billion, but it's down here in the middle of a letter from CEO John Graham that we find out that performance against the reference portfolio was negative $35.3 billion, or negative 10%. If you want the full details, you'll find them down here on page 93. At the risk of editorializing, this behavior of showing off when you're doing well and burying the details in small print when you're not doing well isn't what a group of highly paid professionals does when they're pursuing a common goal. This is more like what a child does when they break something. So you're probably asking, if we know active management doesn't work in general, and if the investment board hasn't managed to outperform their own self-imposed benchmark, why are we pursuing this active management strategy? Why do we even need an investment board in the first place? To understand that, we have to go all the way back to the beginning to learn about the history of the Canada Pension Plan and the creation of the Canada Pension Plan Investment Board. In 1965, the Canada Pension Plan was created to provide a partial source of retirement income for all working Canadians. Contribution rates were set at 3.6% of pensionable earnings, 1.8% from the employee and 1.8% from the employer. Pension benefits were funded on a pay-as-you-go basis, meaning that current benefits were paid from the contributions of current employees, with the Canada Pension Plan holding a relatively small amount of money in reserve. Fast forward to 1996, and this plan was starting to show signs of trouble. Actuarial reporting showed that as the existing population began to age into retirement without enough young people to replace them in the workforce, we would eventually run into a situation where the Canada Pension Plan would either run out of money or have to increase contribution rates to unreasonably high levels for employees. In this case, they saw that we had a problem coming in about 30 years. Contributions coming in weren't going to keep pace with benefits being paid out, meaning that a huge financial burden would be placed on younger employees to make sure the benefits kept flowing to retirees. As a result, the government at the time decided to change the entire structure of the Canada Pension Plan from a pay-as-you-go plan to a funded plan, meaning that the benefits you eventually received would be, at least in part, funded by payments that you yourself made during your working career. This meant a significant increase in CPP premiums up front, but it also meant that those premiums would remain stable into the future rather than continually increasing each year. This meant that for a number of years, we were going to be building up pension contributions much faster than we were paying out benefits, because contributions had increased significantly, but benefit payments wouldn't be following suit for many years. So, to manage these surplus funds, Parliament created the Canada Pension Plan Investment Board by passing the Canada Pension Plan Investment Board Act in 1997. This piece of legislation created an entity to manage the pension fund's investments, which would be managed by a board of directors at arm's length from both the federal and provincial governments. The Act also outlines the purpose of the investment board, which is to manage the pension funds in the best interest of contributors and beneficiaries and to achieve maximum returns without undue risk of loss. There's also some basic rules and guidelines about how they're permitted to invest, but more or less they've got free rein to invest the pension funds as they see fit. Personally, I think this was all generally the right move at the time and reflected some very good long-term thinking. They foresaw a problem coming decades in advance and acted early to get us onto the right track. The actuarial assumptions that we based this new plan on were also pretty conservative in terms of what the investment returns would be, which is a big part of why the fund is in good shape today. The benefits paid out are not that rich relative to the premiums you pay in over your working career, which means that the fund tends to build up money faster than what we see in the actuarial projections. They also built in a system where the fund would be shielded from political interference in investment strategy, which is a good idea, but does have some downsides in terms of accountability, which we'll get into later. So, the new contribution rates went into effect, the investment board was convened, and in 1999 they published their first annual report covering the 6 months ending on March 31st, 1999. By the way, the pension fund operates on a fiscal year, which starts on April 1st of the previous year, so for example, fiscal year 2000 would cover April 1999 to March 2000. They invested the money into a passively managed mix of stocks to complement the CPP's existing bond holdings, and after those first 6 months ending in March of 1999, the fund was managing their first $12 million in net assets, spent about $250,000 on salaries, and in total spent about $1 million of the $6 million that Parliament had allocated them for startup costs. This continued relatively smoothly for the next several years, and in their 2004 annual report, they were managing over $70 billion in assets. They diversified into real estate, infrastructure, private equities, and money market securities. They employed a staff of 51 investment professionals and support staff, spent about $7.3 million on salaries and benefits, $5 million on external management fees, and the total cost of running the organization was $24 million, with the CEO taking home about $924,000 in total compensation. The next year, in 2005, is when the strategy started to shift significantly, and it seems to be related to the appearance of a new CEO, David Denison. Denison took over as CEO in mid-January of 2005 and began outlining plans to expand the organization and increase the role of active management in the pension fund. While acknowledging that this would increase the fund's operating expenses, the report also says that increasing exposure to actively managed assets like private equity would provide an opportunity for higher returns over the long term. By the end of fiscal 2005, the number of staff nearly doubled from 51 to 101, with personnel costs increasing from $7.3 million to $13.4 million. According to a Financial Post article from 2012, CPPIB had about 70 employees when Denison joined in January, which suggests that the majority of the hiring that year happened during those last 2.5 months after Denison took over. The next year, in fiscal 2006, they began the transition to active management in earnest. They hired another 63 new staff, expanded their private investment holdings, salaries and benefits increased from $14 to $26 million, and overall operating expenses increased from $32 to $54 million. This is also when they created the reference portfolio as an accountability metric to justify the active management strategy. Again, this is a passively managed portfolio of equities and bonds that would meet the actuarial liabilities specific to the Canada Pension Plan and therefore represents a viable strategic alternative to the active management strategy. They mentioned several times throughout the document that they believe, despite decades of evidence to the contrary, that talented investment managers can achieve higher returns by selecting investments more wisely than what a passively managed portfolio could accomplish. They also very clearly state that this reference portfolio is central to their accountability framework. Over the next couple of years, the trend of expansion in active management continued into 2008, with total staff increasing to 368 people, salaries and benefits increasing to $95 million, and $154 million in overall expenses. In just 2 years, David Denison's compensation roughly quadrupled from just over $1 million in his first full year in 2006 to more than $4 million in 2008. Then, in fiscal 2009, the active management strategy faced its first real test, which was the 2008 global financial crisis. Remember, the fiscal year runs April to March, so the 2008 crisis was reflected mainly in the 2009 annual report. Apart from higher returns, one of the supposed benefits of active management often mentioned by its proponents is the ability of investment managers to shield the fund from losses in major market downturns like 2008. So, how did the CPPIB's staff of hundreds of professionals handle this scenario compared to their own passively managed benchmark? Well, in that year, the reference portfolio had a loss of 18.63%, while the actual pension fund had a loss of only 18.62%. With a staff of now 490 employees, they managed to outperform their benchmark by a single basis point, or 1/100%. They actually had to add a decimal point to their reporting to show that they had provided any value at all. This was actually a significant controversy at the time, with opposition parties in Parliament questioning why the investment board was paying out millions of dollars in bonuses to executives in a year when the fund had lost $24 billion on its investments. However, then Prime Minister Stephen Harper decided not to intervene on the basis that the board was independent from Parliament and compensation was a decision that they made independently. David Denison himself later remarked that using returns compared to a benchmark also means it's possible to receive no bonuses in hot markets if fund managers don't beat their targets. Of course, the next year, during the recovery in 2010, the fund promptly underperformed the reference portfolio by 587 basis points, or 5.87%, suggesting that their staff of now 566 employees was both unable to protect the fund from losses in a major downturn, as well as unable to capitalize on the gains from the recovery. Despite this underperformance relative to their benchmark, even over the total 4-year period that their compensation is supposed to be based on, Executives were still awarded millions of dollars in bonuses, with Denison himself receiving about $2.9 million in total compensation against a base salary of $490,000. By 2012, when Denison decided to step down as CEO and retire, the size of the staff had increased to 811 employees with personnel costs of $292 million, and the compensation of the top 5 executives totaled more than $12 million. The fund was also paying $650 million in external management fees, more than double what they were spending on internal employees, which is a bit strange given how much they were touting the benefits of having a large internal active management team. Excluding external managers and transaction costs, the operating expenses totaled $440 million for a fund that was now worth $161.6 billion in net assets. Compared to 2004, the overall size of the fund had grown to about 2.3 times the amount of assets under management, while the number of staff had increased to roughly 16 times the 2004 level, salaries to about 40 times the previous level, and overall operating expenses reached about 22 times what they were in 2004. Apparently, Denison wasn't exaggerating when he said that active management would increase operating expenses, considering all of that change happened in just 8 years. Fast forwarding to 2024, the expansion has continued unabated. The CPPIB now has 2,125 employees, personnel costs were $1.087 billion. They spent $530 million on general and administrative costs, and another $3.5 billion on external managers. Since the start of active management, they've also opened 8 international offices in some of the most high-cost areas in the world: New York, London, Sydney, Hong Kong, Sao Paulo, Luxembourg, Mumbai, and San Francisco. On top of that, they've recently announced that they're spending somewhere in the range of $300 million to $430 million over the next 10 years to move their head office in Toronto to a more luxurious, if slightly smaller, office space, with the goal of improving their ability to attract more top investing talent. Again, at the risk of editorializing, I'd say that when they've got 9 offices around the world, thousands of employees, over $1 billion in annual payroll, and billions more in external managers, and over the past 18 years they've still managed to underperform their self-designed passive portfolio alternative, more top talent might not be exactly what we need. It seems to me that in the long run, top talent in the investment management world seems to be a little bit worse than no talent at all. Now, something else that's important to understand is that while underperforming the reference portfolio is not great, given that they've said it's their entire reason for pursuing an active management strategy, there's also the matter of risk-adjusted returns. You may have heard that diversifying into sectors like private equity and real estate means that the fund is actually getting better performance because the risk of loss is lower in a more diversified portfolio. The problem is, the reference portfolio isn't just their performance target, it's also their risk target. The logic is that because the reference portfolio is considered a viable strategy to meet the fund's long-term liabilities in terms of pension benefit payouts, it's reasonable to increase the risk of the actual portfolio to match it to pursue higher returns. The idea is that a more diversified portfolio is supposed to provide the same returns at a lower volatility. This concept was recently outlined in an email about the Canada Pension Plan's performance by Wealthsimple, who coincidentally are also getting more into the business of actively managed higher fee funds. If this is true, we can therefore increase the amount of risk in our portfolio to get even higher returns at the amount of volatility that we already know we can tolerate. So they combine these ideas under the umbrella of diversification and leverage. They de-risk the portfolio by investing in sectors not available to the public, like private equity, private lending, private real estate and infrastructure, and so on. Then they re-risk the portfolio through leverage, borrowing money to invest even more into these strategies. This is all laid out on page 16 and 17 of the 2024 report, where they discuss that their target risk level is equivalent to the risk in the reference portfolios for both the base CPP and additional CPP, which has a lower risk target. Down here on page 121, they say that their risk appetite involves the potential for a 19% loss in a single year for the base CPP and 13% for additional CPP. So, as of the 2024 annual report, although the fund is worth $632 billion, they actually have over $800 billion invested, with about $178 billion in investment liabilities, which, in simple terms, is money that they borrowed to invest through a variety of different methods. Supposedly, this should all result in above-market returns. In this diagram on page 12, they show their key sources of return as the base market returns, described as a simple 2-asset portfolio that meets the pension plan's requirements with the minimum level of risk needed. Then they have a wedge representing taking a higher amount of risk than the minimum. These two wedges together essentially represent the reference portfolio strategy, which provides the performance and risk targets for the actual fund. Then the next 3 wedges represent diversification and leverage, active investment selection, and responding to market movements with tactical positioning. These wedges visually take up about 15% of this pie chart in the diagram, but of course it's not to scale. If we look at the actual 5-year results on page 47, we can see that over the past 5 years, diversification and leverage has resulted in an added value, on average, of negative 4% per year. Their other active management strategies combined have added an average of 2%, meaning that their overall active management strategy has yielded negative 2% per year over the past 5 years, compared to a passive portfolio that will require almost no management at all. So looking back at this chart on page 12, it seems a little bit misleading because the sum of these three wedges, which represent the active management strategy, is actually less than zero. The reference portfolio has averaged an annual return of 9.7% over the past 5 years, meaning that active investment management actually reduced the returns earned by about 20%. Increased volatility isn't the only risk of this strategy, though. Borrowing over $170 billion to invest has also exposed the fund to interest rate risk, meaning that if interest rates increase, the fund could suddenly be paying a lot more in financing costs, similar to what's happening to a lot of Canadian homeowners right now with their mortgages. Interestingly, I read through their section on portfolio risks and they don't bring this up at all. They have a section on interest rate risk, but it's only about how interest rate increases could affect asset valuations. They don't discuss how interest rate increases could affect the carrying costs of their leveraged investing strategy. This risk became pretty obvious when interest rates started increasing in 2022. In the 2022 annual report, the fund spent about $295 million on financing expenses. In 2024, the financing expenses incurred were $6.3 billion, roughly 21 times what we paid just 2 years earlier. This didn't make them more cautious about this strategy, though, because the amount of money they were borrowing also increased from $129 billion to $178 billion over the same time period. According to the latest quarterly report, they still aren't backing off on their leveraged investment strategy. Total investment liabilities have increased to $195 billion. If we look at the expenditures on page 18, we see that for the fund as a whole, about 16% of the gains so far this year were eaten up by expenditures, and financing costs account for a little over half the overall amount spent. Another issue is, although they tend to blame their underperforming years on public equities showing strong growth, leading to the overall fund underperforming because they're more diversified, the underperformance carries through to the public equities portion of the actual fund as well. Although the public equity portion of the reference portfolio returned 23.9%, the public equities portion of the actual fund returned only 13.8%. There's no real explanation for this that I could find in the report, and the difference in performance isn't actually mentioned. The numbers are reported separately in different sections of the report. Apparently, though, whatever decisions they made in how they invest in public equity have resulted in performance that was well below a passively managed fund that just tries to match the overall market performance. So, considering that these are the experts we're paying to provide, in their own words, above market returns, and in this year they've wiped out far more than they built up in the previous 17 years combined, what impact do you think that has on their compensation? Well, there's individual performance goals for bonuses, but the performance bonus for the fund as a whole is based on a multiplier between 0 and 2, which is broken down into two parts: the absolute fund performance and the fund's performance relative to the reference portfolio, each measured over the past 5 years. For the absolute fund performance, they start giving themselves bonuses if the fund makes more than a 0% return. So basically, as long as they don't lose money over 5 years, that's a bonus. They could put all the money in government bonds, or even if they could somehow deposit it into a high-interest savings account, that would still be considered enough investment skill to earn a performance bonus. The other half is for how the fund performs against the reference portfolio. As you'll remember, getting better returns than the reference portfolio is the entire reason for this active management strategy's existence. So what's the threshold for relative performance in order to get a bonus? Well, based on this graph, it's roughly negative $20 billion. So if they only underperform by $20 billion, that's worth getting paid extra. Of course, their 5-year relative performance was negative $63.7 billion, so that multiplier was 0 this year. Average those two numbers together and you get 0.62, which was the overall fund bonus multiplier for the year. But obviously, in the section on compensation, they say that because their performance against the reference portfolio was so bad, the bonus multiplier was too low, and they were only going to apply to the senior management team, and everyone else would get an upward adjustment. In addition, CEO John Graham was awarded a personal performance multiplier of 1.6, leading to an overall multiplier of 1.11. Apparently, this year, in which they wiped out triple the value added in all of the past 17 years combined, was worth not just a bonus, but an above-average one. This was signed by Chair of the Compensation Committee Barry Perry, who I mentioned specifically because he has a hilarious name. This is just me talking here, but if I worked at, say, a pie factory, and then one year I burned down the warehouse where we kept all the pies we'd ever made, and also the 2 warehouses on either side of it, I wouldn't be expecting a bonus at all. I might even expect to receive a stern talking to. Anyway, we spent $1.087 billion on 2,125 personnel, so between salary, bonuses, pensions, and benefits, we spent on average a little over $500,000 per person. Obviously, some people got more and some got less, but that was the overall average. So these all sound like big numbers, but CPP is a big fund, so what does it all mean in context? Well, normally the cost efficiency of a fund is measured by an expense ratio, which is how much they spent managing the fund compared to the size of the fund as a whole. In this case, the chairperson's report mentions that the operating expense ratio for 2024 was 27.5 basis points or 0.275%, which is pretty good. Here's the thing though, that leaves out a whole lot of expenses. Down here on page 46, they go into more detail. According to this calculation, their operating expenses were only $1.617 billion, which only accounts for personnel expenses, basically payroll, and administrative expenses, which covers things like office space and general overhead costs. What they're not including are external managers, financing costs, and a couple of other smaller expenses like transaction fees and taxes. So how much are we paying for these other expenses? If we look at their consolidated statements on page 96, they had $16 million in external management fees, another $62 million in external performance bonuses, just under $6 billion in financing costs, and another $700 million or so in taxes and transaction fees, which are usually excluded from the expense ratio because you have to pay them either way. But that also doesn't tell the whole story. If we look at the unconsolidated statements on page 119, we see they're actually paying about $1.45 billion in external management fees and a little over $2 billion in performance bonuses for these managers for a total of just over $3.5 billion. The reason they give for reporting much lower numbers in their consolidated statements is that those management fees are incurred within investment funds, so they just deduct them from the profits as though that means you didn't actually pay them. Personally, I don't think that makes a lot of sense. Think about it this way. If I go out and buy 3 funds that charge a 2% fee each, then I package them together into a new fund and sell it to you, but I add a 1% fee for myself, is the overall management cost of my fund 1% or 3%? I would argue that it's 3% because you're still paying the fees for those other managers. It doesn't really matter that they're being deducted from the returns at some intermediary step, the fee is still being paid and you're getting lower returns as a result. Likewise, I think it's reasonable to include the $6.3 billion in overall financing costs as part of the expenses. They say themselves on page 46 that the financing costs are being incurred because of their active management strategy, so I think it's perfectly fair to include it in the cost of active management as a whole. In fact, I think it's pretty disingenuous to exclude it. We can take their calculated expense ratio of 27.5 basis points on $1.617 billion in expenses to figure out that they're using a daily average fund value of $588 billion to calculate their expense ratio. Based on that, the total amount of expenses they're incurring works out to 208.5 basis points, or 194.5 if you exclude taxes and transaction fees. So, as far as I'm concerned, the cost of running this fund isn't 27.5 basis points, it's closer to 200. They're just excluding about 85% of the overall expenses from their calculations, which seems like a pretty big omission to me. So, going off on a little tangent here, the reason they give for this accounting adjustment is that they're adjusting for costs incurred within funds and costs from investment holding subsidiaries. CPP Investments actually has 245 unconsolidated subsidiary corporations. Now, that might sound suspicious, but it's not actually anything unusual unto itself. If you have a very large investment fund, it makes sense to enclose certain things within a corporation in order to limit your liability. For example, if you buy an office building or a mall, you might hold that through a subsidiary corporation, so if someone slips on a banana peel and sues the mall, you can only lose whatever is invested in the mall, rather than exposing the rest of the pension fund to a lawsuit or some other type of liability. However, these subsidiary corporations also incurred hundreds of millions of dollars in expenses that were then reclassified into a deduction from income. Another interesting quirk is that while these investment holding subsidiaries made $13.3 billion and $13.8 billion on private investments in 2023 and 2024 respectively, the private investments held directly by the CPP investment fund itself lost $11.6 billion and $4.5 billion in the same years. When you add the two together, you see an overall profit, but more than 100% of that profit is coming from the investment holding subsidiaries. So I started to wonder, do these subsidiaries have their own employees who may or may not be counted in the employee total for CPP investments? In at least some cases, the answer appears to be yes. For example, One Queen Capital, which is an investment management company that's wholly owned by CPP Investments and located in the same building, has about 10 employees who seem to be separate from CPP Investments itself. To me, this is something that deserves more of an explanation in terms of how they decide what investments should be held directly and what should be held through a subsidiary, particularly because private investments aren't subject to constant valuation updates on the open market. And they mention in their financial notes that they sometimes get their valuations directly from external managers. To illustrate why transparency is important here, I'll give you a hypothetical. And to be clear, this is just a hypothetical. I have no evidence to suggest that this is happening here, it's just an example of what could happen when you have infrequently valued private investments and valuations being accepted directly from external managers. So imagine you have a large investment fund which owns a subsidiary corporation which has its own employees. The subsidiary employees are potentially compensated based on the performance of the subsidiary alone, while the employees working directly for the fund are compensated based on the performance of the fund and all of its subsidiaries as a collective. Now, if you've got a mix of private investments, some of which are doing well and some of which are doing poorly, but each party can decide what value to assign them and the other party can choose to accept that valuation directly, you can see how it creates an incentive to move winning investments to the subsidiaries and losing investments back to the main fund. It won't affect the compensation of the direct fund employee because they're paid on the performance of everything together, but it will boost the compensation of the subsidiary employees because they're holding all the winning investments. Again, this is a purely hypothetical example. I didn't find any evidence to suggest that this is happening. I don't even know if this is how their actual compensation is structured, and they do get audited every year, so presumably someone is checking for this sort of thing. However, as someone who pays CPP premiums, I'd be interested to hear why the directly owned investments are losing money in the same years that subsidiary corporations are making huge profits, and why we're spending triple our internal payroll costs on external management fees and performance bonuses in external funds. It would be good to have that kind of information to satisfy us that this sort of thing definitely isn't happening. For the same reason, I'd also be interested to know exactly how many employees we have in wholly owned subsidiaries and how their compensation structure works. Now, while I was looking into these subsidiary corporations, I did stumble on something kind of strange that took me a while to unravel. It's kind of complicated, and putting all the pieces together took me a while, so I'm just going to try to explain it in an order that will make sense instead of the order that I figured it out. Going back to One Queen Capital, our wholly owned subsidiary of CPP Investments, they operate in the United States as well, which means they're subject to a lot of disclosure requirements of the Securities and Exchange Commission, or SEC. While I was reading through one of these reports, I found the shareholder breakdown of One Queen Capital, and while you see CPPIB like you would expect, there's also another holding corporation, but the really odd thing is that there's a couple of individual people's names involved who own shares of One Queen Capital through numbered corporations, which is kind of weird because they say that they're a wholly owned subsidiary of CPP Investments. Now, I've redacted the names of these people because after I figured this all out, I realized these specific people aren't really important, and I'm not interested in starting a witch hunt. For now, we'll just give them fake names, say Barry and Perry. Barry and Perry aren't CPP employees or anything like that. They work for firms that provide specialized legal and financial services, and to make sense of what's going on here, you'll have to know about something called the 30% rule for Canadian pension plans. The 30% rule says that pension plan administrators cannot directly or indirectly own more than 30% of the shares of a company that vote for the board of directors. Now, in general, this means that they shouldn't be buying more than 30% of a company because common shares usually include a vote for the board of directors. The reasoning behind this rule is that governments didn't want pension funds getting involved in the day-to-day operations of businesses because they were concerned that the desire for steady returns for pensioners would undermine the ability of a business to innovate and take risks. This rule applies to all federally regulated pension plans, and it's also specifically restated in the regulations for the Canada Pension Plan Investment Board. However, there are some ways around it, but it can lead to weird ownership schemes. As an example, here's the ownership structure chart for a Brazilian water services company called Igua Saneamento. A small portion is owned by the Brazilian National Development Bank. Then, about a third is owned by an aggregator called FIP Mayam, which is in turn owned by CPP Investments and AIMCO, which is Alberta's public sector pension fund manager. Then, a small portion is owned by CPP Investments directly, another third is owned by FIP Igua, which is owned by CPP Investments and AIMCO, and finally, another 10% is owned by AIMCO directly. Their shareholder agreement does mention the 30% rule, although to be perfectly honest, my Portuguese isn't good enough to tell you what the rest of it means. The way most pension funds get around this rule is by buying something called convertible debentures or convertible notes, which are basically like giving the company a loan that can be converted into equity at a later date. They effectively have ownership of the company, but don't get voting control over the board of directors. This is more or less the conventional way to invest more than 30% for Canadian pension funds. I talked to a couple of people involved in pension investment and pension law, and they were already familiar with this method. But coming back to Barry and Perry and their shareholder status with One Queen Capital, the way CPP Investments gets around this rule is a lot more convoluted. I looked up these two people, and between the two of them, they've got 30 or so numbered corporations registered. Of those holding corporations, I was able to trace 18 of them to 16 other companies that they hold, and all of them were companies that are either currently or formerly more than 30% owned by CPP Investments. These companies cover a wide variety of industries, including investment management, water services, student housing, shopping centers, ventilation, toll roads, medical-grade ceramics, renewable energy, and fracking. It's hard to get many details on these companies because most of them are privately held or based in jurisdictions where there aren't many reporting requirements. But one company is not only based in the US, but was partially sold back into the public market a few years ago, meaning it's subject to SEC disclosure regulations. That company is one you might be familiar with. It's called Petco. Back in 2015, CPP Investments and CVC Capital jointly acquired Petco in a deal worth $4.6 billion. This put them in direct control of the company, so they now have several of their own people on the board of directors. Then, in 2021, in order to reduce some of the company's debts, they sold off a portion of the company through a public offering. CVC and CPP Investments retained 81% of the ownership, so they're still in control of the company, but now we have publicly available information on the value of the company and more of their internal workings. As a quick aside here, you might be wondering if the CPP Investments and CVC people pay themselves a salary for sitting on the board of directors of a company that they bought out. And based on the information in their proxy statements, the answer is no. In fact, they've made themselves ineligible to receive compensation as board members, which is good. So anyway, going into their SEC filings with the new company structure, we see that most of the company is owned as Class A shares, which are ordinary shares that have all the normal financial benefits and voting rights. These shares are owned by CVC and CPP Investments through a holding corporation called Scooby Aggregator, which is, of course, adorable. Here's where it starts to get weird. The remaining equity in the company is split into two subclasses of shares called B1 and B2. B1 shares have all the normal financial benefits of share ownership as well as voting rights for everything except electing the board of directors. These shares are owned by CPP Investments and CVC through holding corporations. B2 shares, on the other hand, do absolutely nothing except vote for the board of directors. These shares are owned through a numbered corporation registered by Perry, but there's a lot of restrictions. They can't be sold, they can't vote without being directed to do so by holders of B1 shares, and B1 shareholders can convert their own shares into Class A stock by directing B2 shareholders to return an equivalent amount of shares to the company. They can also do the reverse process if they need more B2 shares to maintain compliance with the 30% rule. Basically, these B2 shares are under the direct control of B1 shareholders, which is to say, CPP Investments. They've created a system where they've broken off just the ability to vote for the board of directors and put it into a numbered corporation so it can nominally be owned by some guy. But even in these filings, they acknowledge that the shares are under the control of CPPIB and therefore they can be deemed to be the beneficial owner. However, it also mentions that the CEO of CPP Investments, John Graham, disclaims beneficial ownership of these shares. Now, I'm sure that the lawyers at CPP Investments have already approved this, and this is just my inexpert opinion, but I personally would consider that to be an indirect ownership arrangement. However, while that may just be my opinion, I think it's worth noting that it also seems to be the opinion of Petco themselves in their filings with the SEC. By the way, this is why I redacted the names of the people involved. While they're named in these public documents, they don't have any real power in the situation. Ideally, their role would be filled by a potted plant or a turkey sandwich, but unfortunately you need an actual human being to list as a shareholder. The last question I had about this was, in practice, do these shares vote for the board of directors or not? I looked at the latest shareholder meeting results, and to be honest, I don't think there's enough information to tell. Looking at the board of directors vote results, the number of withheld votes and broker non-votes is less than the number of B2 shares. But the total number of votes is also less than the number of outstanding Class A shares, so it's possible that only the Class A shares are voting. I thought these broker non-votes might be the ones owned by CPP Investments, but there's only 18 million non-votes versus 18.5 million B2 shares owned by CPP. Either way, I still think it goes against the spirit of the 30% rule. By creating a bunch of voting shares that you control completely and directing them not to vote, you're still concentrating the voting power into a smaller number of shares, giving you more than 30% of the power. Obviously, CPP Investments and CVC together have total control of the company, which is what the rule is supposed to prevent. Something else worth noting is that the CPPIB has been lobbying the government for years to remove the 30% rule. In their own submission on a government consultation about eliminating the rule back in 2016, they say that the rule doesn't actually prevent pension plans from investing more than 30%, it just makes it more complicated and expensive to create the structures needed to circumvent the rule. They don't mention that they're doing this themselves or discuss how much they're spending on it, but they do say that there's clear benefits to active management and the ability to have a majority interest in a company. Now, because Petco is publicly traded, we can see the share price directly, and to the credit of CPP Investments, it's clear that their wise guidance in this private equity buyout has clearly been of benefit to the... Oh, never mind. Look, I actually don't mind that they're asking the government to get rid of the rule. This rule doesn't exist everywhere, and lobbying against it is the correct way to try to get it changed. In fact, in the most recent fall economic statement, the pension lobby achieved some partial success on this, and they're now allowed to invest in more than 30% of the voting shares of Canadian companies. But here's the thing, this isn't some private pension fund that found a loophole that they decided to exploit. We're talking about a crown corporation that's spending our money to circumvent a rule that we set for them because they think they know better than us. Despite the alleged benefits of active management, as someone who pays CPP premiums myself, I'd prefer if they just respected the rule instead of using our money to create a convoluted ownership scheme that allows them to buy out a company like Petco and run it into the ground. I think it would be good to know exactly how much we're spending to do this, because nobody I talked to during my research was even familiar with the ownership structure that CPP Investments is using to do this, and they're using it for a bunch of different companies. Anyway, I know that section was a slog, but I spent a lot of time going down the rabbit hole to figure out what the hell was going on there, so thanks for bearing with me. Let's move on. Getting back to the main fund, a question that pops up a lot is whether or not we're getting good value for the amount we're paying for this active management strategy. Based on the performance, I'd personally say no, but we can also compare to other large funds like Norway's Sovereign Wealth Fund to see what they're doing on a relative basis. Looking at the 2023 report for Norway's fund, which is the closest date to CPP Investments' 2024 annual report, they had the equivalent of 2 trillion Canadian dollars invested, so roughly triple the size of CPP Investments. The amount that they spent on management fees was about 4.6 basis points, or a little less than 1/20% of the value of the fund. This figure includes internal staffing costs and overhead, but also includes things that CPP Investments leaves out of their management cost figure, like external management fees and performance bonuses, as well as costs incurred in subsidiaries. Their salary costs were roughly 269 million Canadian dollars, so a little less than a quarter of what CPP Investments spent on a fund one-third of the size. In other words, despite also engaging in broad diversification across asset classes, Norway's fund is about 12 times as efficient in terms of staffing costs. They've also only got 654 employees, a bit less than a third of what CPP Investments has, and their executive team has smaller compensation packages. The 12 senior managers at Norway's fund make a combined total of about 80 million Norwegian kroner, which is about 10.5 million Canadian, while the 6 top executives at CPP Investments made a combined total of just over 21 million Canadian dollars. In terms of borrowing costs, they don't engage in the same kind of leverage investing that CPP Investments does, but they did incur some net costs on lending and borrowing, which they use to manage cash balances and liquidity, and that amounted to about 2.1 basis points. So, all told, around 6.7 basis points in order to run this massive $2 trillion fund, which still invests in things like real estate and private infrastructure. To me, that seems quite a bit more efficient than the 194 basis points that CPP Investments is spending. Another quick note, Norway's fund also underperformed their benchmark in that year, but they put that number in large print on the summary page instead of burying it in the report, almost as if this is a fund run by adults who want to be transparent about what they're doing. So coming back to something I discussed near the beginning of the video, there's a repeating cycle involved in how the CPP investment fund underperforms against the reference portfolio. In most normal years, and years when markets are down, they outperform the reference portfolio slightly. However, in recovery years, or years when the market goes up rapidly, they underperform substantially. Over time, this adds up to long-term underperformance. In the 2008 crash, they outperformed the reference portfolio by 0.01%. In the recovery the following year, they underperformed by 5.87%. In 2020, they outperformed by 6.2%, but in 2021, they underperformed by 10%. In 2023, they outperformed by 1.3%, and in 2024, they underperformed by 11.9%. The one exception was in 2016 when they outperformed the reference portfolio by 4.4%, and the following year only underperformed by 3.1%. In that case, they managed to protect us from a whopping 1% decline in the value of the reference portfolio. In fact, while they have a section in the report discussing how resilient the fund is in historical market downturns, the biggest downturn on the chart is 3.1%. In the 2023 downturn that they highlight, the reference portfolio was actually up 0.1%. The only time they've actually been tested with a major double-digit price crash was in the 2008 crisis, which they conveniently leave off this chart. In that case, they did absolutely nothing to protect us from the downturn, but missed out on a lot of money when markets rebounded. So, from my perspective, I don't think that protecting us from relatively small temporary price declines is really worth the trade-off of leaving tens of billions of dollars on the table in good years. Now, I know I've been harping on this the whole video, but I want to reiterate the importance of the reference portfolio in all this, because a lot of the public commentary I've seen on this says that they shouldn't be compared to some random stock index. But the reference portfolio is not an arbitrary benchmark. It's something that CPP Investments created themselves as a viable low-cost alternative, which, in their own words, will meet the actuarial requirements of CPP. They use it as both a risk target and a performance target, and they said that the primary reason for pursuing active management is to achieve higher returns than what we could get with that low-cost passive strategy. They describe it as a key accountability metric for their organization. And they didn't just say it once, they said it again and again and again, and again and again and again and again, and again and again and again and again, and again 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 and again. Look, that's 100 examples. There's more, but you get the point. This isn't some random stock index that I'm unfairly comparing them against. They staked the entire justification for their strategy on the idea that they could outperform this benchmark. So, now that they've ended up underperforming the reference portfolio, their own self-described key accountability measure over their entire 18-year active management strategy, have they decided to go back to a simple low-cost passive strategy and give up their high-paying jobs for the sake of efficiency? No, they're changing the benchmark. This was according to an article in the Globe and Mail after the 2024 annual report was released, where they discussed how the fund has been underperforming against the reference portfolio. Starting this fiscal year, CPPIB will switch to a different performance yardstick. It will aggregate a set of internal benchmarks that track passive alternatives to different asset classes, which are already used by individual investment teams internally. It is a change that has been in the works for a long time, Mr. Graham said. Graham went on to say, if CPPIB one day decided to put all its assets in passive investments instead of employing large investment teams to try to earn higher returns, the old benchmark is not actually what we would do. It's too concentrated, he said, so let's actually incent people, let's reward people against the benchmark or against a portfolio that we actually want to build. Now, the problem with this is that the reference portfolio is meant to be a simple, low-cost alternative that still meets all the actuarial requirements of the CPP. The fund does have internal benchmarks for each segment of the portfolio, but if we start using an aggregate of those benchmarks, we're basically building in an assumption that the choices they made on how to build the portfolio are correct. In other words, we're building in the assumption that active management is the right strategy. They won't need to justify active management anymore because their benchmark is based on the choices they already made. Leveraged private equity buyouts, major real estate and infrastructure purchases, private lending deals, these don't need to be justified against a passive strategy anymore because they're automatically considered to be the right move. It's hard to tell exactly what they're doing without more details, but another way to look at it would be that they're taking the diversification and leverage portion of the strategy, which has yielded an average relative performance of negative 4% over the last 5 years for a total of negative $97.7 billion, and just absorbing that into the benchmark that they're going to use to determine their bonuses. John Graham himself probably has a lot of personal motivation to change the benchmark, given that 2 recent massively underperforming years happened under his leadership. In fact, if we look at the 4 years that he's been heading CPP Investments as their CEO, we've paid him about $18.5 million in direct compensation. But the fund's performance against the reference portfolio has been roughly negative $87 billion, or if you compound it, $93.7 billion. So I understand why he wants to change the benchmark, but I don't see why we, as the clients, should accept that sort of change. After all, aren't we paying this guy millions of dollars a year because he's supposed to be a talented investment professional who can anticipate these kind of trends in advance and allocate our money accordingly? If the only benefit is diversification, we don't really need active management to do that. On top of that, fiscal 2025 is shaping up to be another year of big gains in public equity, meaning there's a pretty good chance they'll be underperforming the reference portfolio again, although we won't see it reported if they change their benchmark to something else. Now, we can debate endlessly over the exact role of CPP Investments and how they manage the pension fund, but in my personal opinion, although they may see it differently, the way they've been operating reflects an attitude of entitlement. When active management first started, they outlined a very specific benchmark as an alternative to compare themselves against in order to justify their jobs. Now, even though they've been performing below that benchmark, they're still giving themselves performance bonuses. They're saying the benchmark needs to be changed because it just ain't no good no more. They're spending hundreds of millions of dollars on luxury office space for themselves. They've looked at the 30% rule, which was specifically placed on them when the CPPIB was created, and said, hey, we can circumvent this rule because we know better than the elected officials who created our organization. My question is, in what other context would this be acceptable? The rest of us need to continuously justify our jobs, and if you're a Canadian around my age, there's a good chance you've been laid off at least once in your career due to economic circumstances beyond your control. On the flip side, it seems like there's no situation in which the active investment team at CPP Investments would even be denied a bonus, let alone have their jobs put into question. Now, with all that said, I realize that there's going to be people criticizing what I've said in this video, saying I just don't understand what I'm talking about, it's much more complicated, and the system we have right now is actually the best possible option. In fact, since I've been posting about this on social media, I've had a lot of people reach out to me about it with specific criticisms. So, to save myself time having to respond to these individually in the comments, I'm just going to address all of them right now in the video. Here we go! Apart from the discussions I had personally, I'm also going to address a lot of what's said in this article on Pension Pulse by Leo Kolovakis, which he wrote in response to a column written in the Globe and Mail by a prominent grumpy old man, Andrew Coyne. Coyne has actually been talking about this for the past decade, but due to the limitations of print media, has never really gotten into a deep dive on it, which makes it easy for pension managers to dismiss his articles, generally by just saying he doesn't know what he's talking about. By the way, this isn't anything against Kolovakis personally, he's just summarized a lot of the common arguments in favor of active management into a single article. The first and most common thing I hear people say is that it's not fair to compare the pension fund against a passive benchmark because you need to consider volatility, risk-adjusted returns, and so on. Kolovakis goes as far as to say, this obsessive focus on beating the reference portfolio is so wrong and, quite frankly, stupid. First of all, as I pointed out many times in this video with numerous examples from their own reports, it's not a random market benchmark, it's a performance target that they created for themselves to justify spending enormous amounts of money on active management. It's entirely reasonable to compare them against that standard. But as we discussed earlier, they're not even pursuing a lower risk strategy with diversification because they add leverage to re-risk the portfolio to be the same risk level as the reference portfolio. This is something they're constantly talking out of both sides of their mouth about. In some contexts, they say that the portfolio is lower risk and more resilient than the reference portfolio, but if you read the actual strategy they're using as described in their financial reports, they haven't lowered the risk at all. But another thing worth talking about in terms of volatility and risk is their use of private investments. Private equity and real estate now make up about 47% of the overall portfolio, and the rationale behind this is that they can still achieve high returns, but they result in lower volatility for the portfolio as a whole. The problem is, private investments are not marked or given an estimated market price at nearly the same frequency as public investments. With things like publicly traded stocks, you always know the market value because those assets are always changing hands on the public market. With private equity, there's no public trading, so you have to estimate the value based on how the business is doing, and that might only happen, say, once a quarter. So while it might look like there's less volatility, it's really just because the asset isn't assigned an updated value as frequently or openly as public assets, and you only find out the true value when you actually sell it. This is sometimes referred to as performance smoothing, or sometimes by the more pejorative term, volatility laundering, because it creates the appearance of low volatility, when in reality the true volatility is unknown because the asset is traded so infrequently. There's a good article by Christopher Carano of 2 Sigma, which I'll link in the sources for this video, where he discusses what happens when you remove this smoothing effect. When you take out the effect of the lower frequency of asset valuation for private equity, the volatility ends up being pretty much the same as public equity, and the correlation between the two asset classes is about 89%. The article concludes that the diversification benefits of private equity mostly only exist on paper. Another important consideration here is liquidity, which is the ability to quickly convert your assets into cash. Publicly traded assets like stocks are very liquid because you can generally sell whatever portion of them you like in a matter of seconds. With private investments, you need to find a buyer, and then they need to be willing to buy the right amount at a price you're willing to accept. These deals can take months or even years to organize, depending on the size of the asset. Supposedly, the benefit of lower volatility is that if CPP needs to pay out money to retirees, you don't want big swings in portfolio value because selling assets while the valuation is down is not ideal over the long term. The thing is, if you're trying to manage that risk using illiquid assets, it becomes a lot harder to spread the losses around when you run into a cash flow issue like that because you need to find a new buyer who might not agree with the exact price or quantity of the investment that you want to sell. So how much of the portfolio is actually tied up in this sort of investment? Well, it's been rising steadily over the years, and if we look at private equity and real assets as a fraction of the total investments, it's a bit less than half of the total. But there's other market segments in the portfolio too, so we can look at their fair value accounting policies to see where they actually know the value of an asset or where they're just estimating it. Here on page 107, they describe the different levels of their fair value measurement. Level 1 is assets that have quotes in active markets for identical assets, so for example, stocks that are traded on the open market. Level 2 has other types of pricing that are still directly observable, and Level 3 is based on what they call unobservable inputs. This means that they aren't traded in active markets, so they use a variety of techniques to estimate what the value might be if they sold them. In some cases, they just rely directly on a valuation provided by an investment manager. In fact, for investment funds totaling about $116 billion in assets, this accounts for 100% of their valuations. According to the table on page 108, when you add it all up, these level 3 investments relying on unobservable inputs for valuation represent just over $381 billion in net investments, or about 60% of the net value of the entire fund. So going back to the matter of the fund being resilient in downturns, I'm not even sure that's a reliable statement, given that the majority of the fund is in assets where the true market value isn't really known on a day-to-day basis. But putting all of that aside and going back to the original point, the key thing here is that the reference portfolio is not a random number or an unfair comparison. It's a portfolio they created themselves to use as both a performance target and a risk target. So by their own definition, it's absolutely fair to compare them against that standard, particularly when they're paying themselves gigantic salaries on the basis that they're able to outperform it. The next common complaint is that passive management simply doesn't work for large funds. People say that as you start handling more money, you need to switch to active management to address the complexity that comes with it. First of all, I'd say that this is contradicted by CPP Investments themselves by describing the passive reference portfolio as a viable alternative investment strategy and using that as the basis to justify active management. But besides that, it's contradicted by real-world examples. Nevada's public sector pension plan, NVPERS, is a fund that's currently worth over 90 billion Canadian dollars, and for many years, their passive investment management strategy was handled by one guy named Steve. I don't know why him being named Steve makes it funnier, it just does. Now, admittedly, they no longer have a one-person department. A few years ago, they doubled the size of the investment management team and hired a second person. This wasn't because Steve was overworked and incapable of managing the fund, though. It was more to address the risks associated with a one-person department. If Steve won the lottery or got run over by a bus, they didn't have a backup Steve. In a lot of ways, Steve Edmondson is the complete opposite of the CPP Investments approach. Instead of continually growing the staff and spending huge sums of money to beat the market, he focuses on minimizing costs while matching the returns of the market. Instead of opening multiple international offices and spending hundreds of millions of dollars on moving to a more luxurious head office, he brings his own lunch to work and gave up a portion of his own office so the accounting department could use it, saying, "I'm not going to complain about my office. It was too big." Now granted, the CPP fund is about 7.5 times larger than the Nevada pension fund, but I'm not entirely convinced that that requires a staff that's more than 1,000 times the size. Nevada isn't giving up returns with this strategy either. Over the past 40 years, they've averaged a 9.4% annual return, which is far above the CPP's actuarial requirements. CPP's own performance since the start of active management in 2006 works out to 8.3% annually, and although that's over a different length of time, it doesn't speak too much to their ability to consistently generate above-market returns. They're getting outclassed by a guy with a wooden inbox and a tuna sandwich. The next thing I see people bringing up is that passive management can't work for a pension fund because of the complexity of liability management and the problems that volatility would cause with that. Basically, pension funds have to pay out benefits to retirees, and if the value of the fund fluctuates, that could cause problems if you have to pay out a large amount of benefits in a year when the portfolio is down. In a personal finance context, this is usually called sequence of returns risk. Usually, higher returns come with higher volatility, so for a pension fund, you need to find a balance between the two. This is also the area where people like to throw a lot of jargon at you, like 3 sigma event, which basically means a low probability, high consequence event in the market. The argument is that active managers can react to these events and mitigate the losses, while a passive strategy cannot. I think for this case, the Nevada pension plan is a great example of a fund that handles these risks without the use of active management. They actually have a much more complex liability management scenario than CPP. For CPP, everyone in the country who earns income is required by law to participate. There's only one contribution rate, and it maxes out at a certain income threshold. There's also no serious risk of the national pension plan being wound down and eliminated in the foreseeable future, so we can anticipate a steady flow of new contributors as people join the workforce. In Nevada, on the other hand, you've got multiple different classes of employees with different pension entitlements and different income levels. There's also the possibility that a government service could be privatized, which means existing pensioners would need to continue being paid their benefits in the absence of new contributions coming in, which needs to be planned for. The thing is, managing these risks doesn't require a complex investment strategy, it just requires good actuarial planning and using an asset allocation that reflects the amount of volatility that you can tolerate. That means you pick a mix of public equity, fixed income, and private investments based on how much the value of the fund can fluctuate, while still making sure you can pay out all the benefits you need to. So, how do we figure out how much volatility is acceptable? Well, not to hammer on this point too much, but CPP Investments uses the reference portfolio as their risk target, which means they've already determined that they're willing to accept the level of volatility associated with a passively managed portfolio that's 85% stocks and 15% bonds. But more generally, your tolerance to volatility depends on how much money you need to pay out relative to the overall size of the fund. This is more or less equivalent to the concept of a withdrawal rate used in personal finance planning. So first, I want to look at the exposure to volatility that the CPP fund has had so far. Over the past 25 years, we can look at how much contribution money flowed into the fund versus how much was paid out in benefits, and see how many times they've had to actually cover a net payout. And the answer is 0! Every single year, they've been net recipients of money, which means their exposure to volatility has essentially been 0. It doesn't matter how much the portfolio value has fluctuated, because they never had to make a net payout anyway. But what about the future? The fund only got started in 1999, so obviously as more people start retiring, we're going to have to start making net payments out of the fund. So what's a safe amount that we can take out each year? I know the pension bros are going to scream at me when I say this, but just hear me out. Back in the late 90s, there was a widely cited paper about retirement that became known as the Trinity Study, which looked at how much money could be withdrawn from a passive portfolio of stock and bond index funds without running out of money. They ran a large number of simulations of different scenarios to see what the probability of success was for different withdrawal rates. The recommendation they came up with was 4% annually, but that was based on a 30-year retirement, and success was just defined as having more than $0 left at the end. Of course, for a pension fund, the time horizon needs to be much longer, the risk needs to be lower, and the value of the fund needs to be preserved and grown, not depleted, because there's new people coming in all the time who will eventually need to be paid out as well. So a 4% withdrawal rate is not going to work. Fortunately, in the intervening years, as access to simulation tools became a lot more widespread, there's been a lot of updates. This article from Karsten at Early Retirement Now ran similar simulations using a variety of withdrawal rates and different mixes of stocks and bonds, but extended the time frame to 60 years and included a requirement that the value of the retirement fund has to be fully preserved at the end. What they found is that by reducing the withdrawal rate from 4% to 3%, they achieved a 100% success rate over 60 years with full capital preservation for portfolios where stocks made up 75 or 100% of the assets. CPP's risk target is 85% stocks, so they would fall into the same bracket that we're talking about here. Keep in mind that in most cases, you'll actually end up with a lot more money at the end, but ending up with the same amount is considered the floor for success, which is important because for a pension fund, having, say, a 5% chance of the fund failing would be totally unacceptable. Now, if you're a finance bro who's yelling at the screen because I've dared to compare retirement planning to pension management, yes, of course, managing a pension fund is different from a retirement fund for a single person. This is just a very high-level overview of the concept of managing volatility and risk when making net payouts from a passive index portfolio. Keep in mind that this video is for a general audience, meaning that the majority of people watching don't already know all of this stuff, so I'm trying to build up their overall understanding to put what I'm about to say into context. The point here is, 1% difference in withdrawal rate makes a big difference. Taking out 3% per year is much safer than taking out 4% per year. Overall, we're talking about how much you can take out of a fund without it causing problems due to temporary market downturns. But even then, yes, obviously, you wouldn't want to start paying out 3% of your pension fund annually based on something you saw on a personal finance blog. To get a better idea of how this actually plays out with real pension funds, we can look at Nevada again. Looking at their latest financial report from 2024, if you look at the net benefits paid out versus the fund's value at the beginning of the year, they paid out about 2% of the fund's value in 2023 and 1.23% in 2024. This is pretty similar to previous years, and the number does tend to go up or down a little bit as the fund's value fluctuates, but basically they seem confident in being able to pay out 2% of the fund's value in a given year, even if there's some years where the value drops, because in most years they make significantly more on investment returns than they pay out on a net basis. So for all the finance bros out here, the point of this whole section was to explain that a 2% annual net payout seems pretty sustainable, even with a passive investment strategy that's susceptible to market volatility. So how much does the Canada Pension Plan need to pay out, and would we be able to handle it even without a team of active managers picking our investments for us? Well, we can look at the latest actuarial projections for the CPP published in 2022. If we take a look at the base CPP projections, we're not even going to hit a 1% net payout rate until 2052, and by 2100, we're still below 2%. So personally, I don't really think the volatility of a passively managed fund presents an existential risk to the CPP. But you don't have to take my word for it, because remember, CPP Investments themselves describe the reference portfolio as a viable alternative that could meet their liability requirements at a low cost. Besides that, if you remember the earlier parts of this video, when stock markets tanked in 2008, our active management strategy didn't do any better than the passive strategy anyway. So I also question the idea that having a bunch of investment managers in the mix means that we won't be exposed to volatility in a market crash. Remember, just because they underperform in good times doesn't mean they can't also underperform in bad times. Again, for the finance bros, I realize the pension plans don't exactly work on a withdrawal rate. The benchmark used by CPP is a stabilized assets to expenditures ratio, which is somewhat similar, but I'll get into that later. So to sum up, what does a passive strategy do to react to market downturns or 3 sigma events? The answer is nothing. The way you deal with bad years is by staying invested and not accumulating errors in the good years, because on average, most years are good years. The gains you make during all those 0 to 2 sigma events are more than enough to deal with the 3 sigma events. The next argument I've heard a few times is that CPP Investments is outperforming the original actuarial projections, which is a better indicator of performance than the reference portfolio. On the Pension Pulse blog, this was described as the ultimate measure of success, the rest isn't as important. In fact, CPP Investments themselves put this chart on page 6 of the 2024 financial report. Remember that they didn't get into a discussion of the results relative to the reference portfolio until page 39. They even mentioned that they've hit a fund value of $600 billion several years ahead of schedule, which sounds pretty good. Now, in my opinion, this is, for lack of a better word, total bullshit. This is a very disingenuous comparison, and I'm going to explain why. As I mentioned earlier, actuarial reports are financial projections based on the way things are now and are assumptions about how things will go in the future. The point of actuarial projections for a pension fund is to identify and solve issues far in advance, just like they did back in the late 90s when they switched the CPP from pay-as-you-go to a funded plan. To make sure that we can spot those issues, actuarial reports are updated periodically, every 3 years in the case of CPP. That's because, as you probably know from your own life, reality has a way of drifting away from your expectations over time. Actuaries understand that their predictions aren't perfect, they're just a way of assessing risk, so they need to evolve as time passes. Now, here's the problem. What CPP Investments is comparing themselves against isn't the latest actuarial report. For base CPP, they're using the actuarial report from when they first switched to a funded pension model all the way back in the year 2000. And for additional CPP, they're using the report from 2018 and basically adding those two projections together to get a projection for the overall value of the fund. They then compare this to the actual fund value and basically say that they're ahead of schedule because of their active management strategy and total portfolio approach. The issue with this is that, as I said, reality tends to drift away from your expectations. For example, in the 2000 actuarial report, they projected that the population of Canada, excluding Quebec, because they have a separate pension plan, would be about 29 million people by 2025. As of Q4 of 2024, the actual number was well over 32 million. It might not sound like a huge difference, but that puts us about 22 years ahead of schedule for population growth. And that's not something recent. Our population has been growing faster than expected for the whole time since 2000. That has significant effects on the amount of pension contributions being paid into the fund, as well as the amounts that we'll eventually have to pay out, which is why we update actuarial projections every few years. So let's take a look at what effect that had on the net cash flow coming into the CPP investment fund. which is to say pension contributions being paid in minus pension benefits being paid out. Here's what was projected based on the 2000 and 2018 actuarial reports. By the way, because the actuarial reports are based on calendar year and financial reports are based on fiscal year, I time shifted the data in this series by interpolating to the end of the first quarter, so that it's on the same basis as the financial reports. In real life, the contributions will be slightly front-loaded in the year because some people hit their max contributions before the end of the year, but it doesn't make a difference in the overall results. However, if you notice some small differences in the numbers here versus the numbers in the report, that's why. Anyway, here's what actually happened. In 22 of the last 24 years, net cash flow into the fund has been more than the projection, sometimes by $10 or $15 billion. Something I want to give some extra explanation for is this period from 2005 to 2007, when almost $40 billion more than the projected numbers flowed into the fund. This is because in 2005, the government began transferring their old bond fund that they held for the old version of CPP into the new fund at CPP Investments, so that it would all be consolidated in one place. The actuarial reports already considered that money part of the CPP fund, and in 2006, CPP Investments consolidated those extra contributions back into their previous numbers for the total fund value, so they've at least remembered to adjust for that in their comparison. Now, although they boast in their report about how their strategic decisions have led them to exceed the projections by more than $150 billion, if you just add in the extra contributions and have them grow at the required rate used in the actuarial report, you end up with an extra $137 billion more than the original projections. The rest of the additional money comes from taking on a higher level of portfolio risk than the minimum amount needed to meet the actuarial requirements. This is all outlined in the last annual report, and as we discussed throughout the video, the rest of their active management strategy actually has a negative impact on returns. Again, if we just gone with a simple low-cost passive investment strategy, at the same level of risk, we'd have tens of billions of dollars more in the fund than we do today. So no, I'm not exactly impressed that they're outperforming the original actuarial projections, because the majority of that is because we've been paying in more money than they projected, and either way, they're still underperforming their own benchmark. Another response I frequently hear is that the Canadian pension model is world-renowned, therefore whatever CPP Investments is doing must be correct. The first question I would ask is, world-renowned according to whom? If it's other investment managers, then yeah, I can believe that. A model that involves hiring thousands of staff, paying billions in salary, and billions more to external managers is naturally going to be viewed favorably by the finance industry that's benefiting from it. But apart from that, let's look at what the Canadian model actually is. There's a lot of summaries about this online, but this blog post called Exporting the Maple Model sums them up pretty well, and it basically boils down to a few main points. Hiring internal investment management teams and paying market compensation, investing in a variety of asset classes, including large illiquid investments like private equity and real estate, and that these strategies lead to a big benefit, which is having fully funded pension plans with funded ratios often in the range of 100 to 120%. First, I think the internal manager part falls a little flat in terms of CPP investments. If one of the big benefits of the Canadian model is using internal managers to keep costs low, why are we spending 3 times as much on external managers as we are on internal staff? Next, in terms of asset diversification, we are doing that, but it doesn't really require a complex active management scheme. If we absolutely need private investments in the mix, we can hire external managers to do it, which, as you know, we're already doing. But this is also questionable as a benefit of the system. In this paper on the sustainability of the Canadian model, the use of illiquid alternative assets as major parts of the portfolio is mentioned specifically as something that might need to be reduced in the coming years. As more and more baby boomers retire and start taking CPP, and as the fund starts making net payouts on an annual basis, they'll need more liquidity to support that, which means divesting from some of those large illiquid assets. If you need to raise some cash quickly, for example, it's much easier to sell a handful of publicly traded stocks than it is to quickly find a buyer for, say, 2% of an airport. Now, addressing the last point, that Canadian pension plans are fully funded. Fully funded basically means that if you were to shut down the pension plan today and have people stop paying into it, you would still be able to pay out all of the pension benefits accrued by people who had been paying into the plan so far. So if your funded ratio was 100%, you would eventually pay out all of those benefits and have nothing left in the fund. If your funded ratio was 120%, you'd pay out all of your liabilities and still have money left over. On the flip side, many pension plans out there operate with funding ratios below 100% because they expect the fund to continue existing and new workers to keep paying money into the plan in the future. This actually specifically came up in a discussion I had with a pension manager about this, where he mentioned that the passively managed Nevada pension fund only has a funding ratio of about 75%, and I'd be hard-pressed to find a public sector pension fund in Canada with a worse funded status. Nevada's funding ratio has been steadily increasing over the past decade, but 75% is still lower than the 100 to 120% mentioned in the blog post. My first response to that is that funding status isn't really a matter of active versus passive investing, because if you can get the same returns with a passive portfolio, your funding status will also be the same. That's just a matter of actuarial planning, which is to say, if you want a higher funded ratio, you just increase the contribution rate so that people are less reliant on new employees coming into the system. But the second thing is, the CPP is still not a fully funded plan. In a report from 2010 on the technical aspects of financing the CPP, they mentioned that the goal is not for the plan to become fully funded, and in fact, it wasn't projected to ever reach a funding ratio of greater than 1/3. In fact, if we look at this footnote on page 187 of the latest actuarial report in 2022, we see that the funding ratio only works out to 32.2%. And actuarial liabilities at that time were already over $1.6 trillion, significantly more than double the fund value today. So by that measure, the Nevada plan actually looks much more robust. Now, before you panic, this is all discussed in the reports as well as in an interview that Rational Reminder did with Canada's chief actuary, Asia Billig, a few months ago. She explains that the goal for CPP is not to get to fully funded status, it's to achieve a stable or increasing ratio of assets to expenditures over the long term without having to change the contribution rate. In other words, the total value of the fund versus the amount they're paying out in benefits on an annual basis should stay the same or grow larger without needing people to pay in more. As of the latest report, the ratio for base CPP was about 10, meaning that they pay out 10% of the fund's value in benefits every year. This might sound crazy compared to the 2% withdrawal rate I mentioned earlier, but keep in mind that we've also got contributions coming in, so the net amount being paid out is still very low for the foreseeable future. Although this is technically more risky than a fully funded plan, I tend to agree with our chief actuary here. The fund would only be at risk if we suddenly decided to shut down CPP entirely, but realistically, it's a long-standing government program with mandatory participation. From that perspective, there's not much of a problem with a low funding ratio as long as we're planning ahead to make sure we have enough of a buffer that we won't need to raise contribution rates to keep the plan sustainable. The assets to expenditures ratio for base CPP is projected to increase to 13.2 by the year 2100, so the plan is on track to become more sustainable, not less. Either way, the real point is that funding status has absolutely nothing to do with active versus passive management on the investment side. It's just an actuarial planning thing. So, I'm aware that that was a tremendous amount of information to dump on you. I'm sure some people will agree or disagree with different parts of what I said, which is a good thing as long as you're thinking through your opinion on it. But with that said, I want to wrap this video up by talking about what can be done and some final overall thoughts. First, I want to reiterate that I am not against the Canada Pension Plan. I think it provides a useful stream of retirement income for every working person in the country, and whether or not it's the most efficient way for me to invest personally, I think it's worthwhile having that financial backstop for the whole of society. In fact, the one encouraging thing in all the research I did for this video is that I'm now much more convinced that the CPP will still be there when I retire because of the sound actuarial planning that was done up front and that continues to be done today. What I'm against is something called financialization, which is the steady increase in the proportion of profits in the economy being made through purely financial channels instead of productive activity. One aspect of financialization is where the finance industry inserts themselves into processes where they aren't really necessary and extract profits for themselves without providing a tangible benefit. The fact is that this active management strategy has been going on for almost 2 decades now, and they still haven't been able to demonstrate that they can achieve better returns or protect us against major market downturns. But they have, over those 2 decades, created thousands of jobs for themselves and paid themselves billions of dollars, with billions more going to external investment managers, all to achieve performance that's a little bit worse than if we did nothing. Even though the fund is still sustainable with this strategy, and we should be able to collect our retirement benefits when we hit retirement age, I still don't like that we're paying billions of dollars to fund managers that aren't fulfilling their promises that were supposed to justify their compensation. I would rather see that money being reinvested for the future of the fund as a whole. It probably won't provide any benefit for myself by the time I retire, but eventually, if the fund grows large enough, it could be a real legacy for future generations who could use it to pay higher benefits, reduce the premiums they have to pay, or invest the excess funds into some other purpose that they choose. That's the problem I have. We, as people who pay premiums into the CPP, are essentially having our pension fund being used to pay for people who are claiming they can outperform the market and they haven't been delivering. The billions of dollars they're paying themselves ultimately come from the money that's coming off of our paychecks every 2 weeks as a mandatory deduction. They should be able to provide value for that money, and if they can't, they shouldn't be taking it. I'd much rather see that money go towards future generations of Canadians as a whole than having it paid out as massive salaries for fund managers. And that's really a key point. People who want to continue with the status quo will push hard to equate this active management strategy with the CPP as a whole and try to make the conversation about supporting our national pension plan. But what I'm talking about here isn't whether or not we should have CPP. What I'm talking about is whether or not we need a gigantic multinational investment management corporation to handle the funds held in trust for CPP. That's very different from trying to get rid of the national pension plan entirely. What I want to do is ensure that the money we're all putting in is being handled wisely and not just being scooped up by opportunistic investment managers. Another thing I expect to hear about if this video gets any traction at all is the idea of the Alberta pension plan, which is something that's been thrown around for a few years now. The Alberta government seems to think they own roughly half of the CPP fund and have been paying for the whole country, which, if you know anything about math, doesn't make a whole lot of sense. Even if they split off, I don't think there's any magic formula where Alberta will suddenly be paying a lot less for much better pensions. CPP benefits are based on individual contributions and it caps out at a certain maximum earning level each year. It's not like equalization, where Alberta residents are putting in tax revenue and getting nothing back in return. It's an amount linked to what each person has contributed. But more importantly, splitting it off into another pension plan would just be duplicating the bureaucracy without any real benefits in terms of management. Presumably, the Alberta pension plan would be rolled into AIMCO, which also has an active management plan. If you recall, they even went in on a private equity deal with CPP for that Brazilian water services company. There's also a question of whether the Alberta government is angling to invest the money into projects that they personally favor, like oil and gas. This would be an even more hands-on, ideologically driven form of active management. Besides that, splitting this off into another government pension plan is a ridiculous idea in a country where people move between provinces all the time. We've already got the QPP for Quebec, now imagine they split off the APP as well. If you're someone who works part of your career in Toronto, then you work in Montreal for a couple of years, then transfer to Calgary for a while, by the time you retire, you're going to have to deal with 3 separate government pension plans, and I can't imagine that's going to result in any extra benefits for all the extra headache. In my view, the best approach is to just take advantage of economies of scale and make the CPP investment fund run as efficiently as possible with minimal interference from investment managers and government interests. So, just to reiterate one last time here, the entire justification for going with active management was that they could get higher returns than a passively managed alternative portfolio. They designed that benchmark for themselves as a viable strategic alternative that could actually meet all of the goals of the CPP. Over the past 18 years, they've hired thousands of people, opened 8 international offices, paid themselves billions of dollars in salary and bonuses, paid out billions more to external fund managers, and pursued a 12-figure leveraged investment strategy, all in the name of achieving above-market returns, and they haven't managed to do it. Regardless of all the complicated jargon they try to throw into the conversation, this is really very simple. They set a target for themselves to justify spending billions upon billions of dollars of our money, and they failed to meet that target, let alone exceed it. And now that it looks like they won't be able to meet it any time in the near future, they've decided it's easier to just change the target instead. So what do we do next? Well, to be honest with you, I really don't know. The best I could think of to do was make a really long video about the situation to explain my position to people, but beyond that, I'm not sure exactly what the next steps are. This is a really difficult political issue to crack because if any political party moves to change the CPP, they'll immediately be attacked by the opposition parties with the help of the finance industry, who have a really strong incentive to make it seem like this is all too complicated for us to understand, and we just need to trust what they tell us about it and pay them a lot of money for the privilege while we're at it. Really, the main thing I would say is, try to learn more about it. Don't just trust what some guy on the internet tells you, really try to gain more knowledge and understanding of the issue. Talk to other people about it, and hopefully, with enough public understanding, we can eventually hold people accountable. Speaking of accountability, who is actually accountable for this whole situation? Well, it's a tricky question because the investment board was created at arm's length from both provincial and federal governments. Technically speaking, the board of directors is accountable to Parliament, and the fund managers are accountable to the board, but in practice, Parliament kind of leaves the board alone to do what they want, and the board just rubber stamps whatever the fund managers want to do, so basically, they're only accountable to themselves. So what's with the board of directors anyway? Well, they basically face the same kind of problematic incentives that the fund managers do. Back when active management was just starting, board members received less than $50,000 in compensation, with the exception of the chair of the board, who received $95,000. Now, with the increased size and complexity of the organization, they receive about 3 or 4 times as much, with compensation ranging from $150,000 to $230,000 per year. Keep in mind, being on the board is not a full-time job. Pretty much all the people on the board have other jobs, other companies, other board positions, or some combination of those things. The job itself involves going to a couple dozen meetings per year, and they get bonus pay for actually attending the meetings. In fact, there's even extra compensation associated with attending a partial meeting. So, while it's hard to say what the motivations of any particular board member are, none of them really have any incentive to shake things up, especially not in a way that moves the organization towards a smaller, low-cost format. As long as they don't rock the boat, they can all keep collecting their stipend, and nobody's really going to stop them. So, I don't really know what else to tell you other than that we can't really make this a partisan political issue if we want to solve it. This has been going on through multiple federal governments, both conservative and liberal, and neither of them have dared to really ask questions about what's going on with CPP investments. If we, as the public, don't actually understand the issue and just try to blame it on one party or the other, there's absolutely no chance it's ever going to be solved. It'll just become another political hot potato, and politicians will absolutely manipulate the narrative to make it seem like the other side wants to destroy the CPP. We, as the public, need to understand the difference between CPP and CPP investments. We need to understand the difference between active and passive management, and we need to understand how they're actually approaching risk in the portfolio, instead of just assuming that having these thousands of employees is somehow critical to keeping the fund low risk. This is not a question of whether or not we should have CPP, it's a question of whether or not our investment strategy needs to be spending billions of dollars every year on management fees and financing costs for things like private equity buyouts, private real estate deals, and leveraged investing schemes. In my opinion, we should be working to make the fund more straightforward and transparent rather than continuously increasing the complexity and further embedding all of these fund managers into the process. Personally, I don't think it's necessary to immediately jump to an overhaul of the whole system. But at this point, the CPPIB was created 25 years ago, and I think it's entirely reasonable to have a review of their performance, as well as what we think the scope of their investment management team should be, and what investment strategies are reasonable for them to pursue. Well, that's all I've got for this video. If you're one of the 8 people who've made it this far, thanks for watching, and hopefully you found this information useful somehow. I spent quite a few months working on this one, and I don't really expect a lot of people to see it or care about it, but at this point, I just needed to get the information out of my head and into a finished format, so here it is. As a parting note, please don't just take everything I say at face value. Look into it for yourself and make up your own mind. I'm going to prepare a document with the sources I use for this video, so if you want to look into it for yourself, look at the video description and check it out there. If there's one thing I try to promote on this channel, it's thinking critically about the information you come across, and that applies to me just as much as it does to any other sources. So, as always, thanks for watching, and I'll see you next time.